Lockheed Martin reporting $5 a share. The estimate was $4.77. The revenue number, I'm trying to get a clean number here that's breaking it out in all the different segments. The stock is up $2.91. As you can see, at this point, aeronautics sales, $5.55 billion. Missile and fire control sales, $2.41. Rotary and mission system sales, $3.77 billion. Total sales, I don't know if we have to add something else in there, 14.4 versus a current of 14.2. So that looks like it's above as well. Stock up a little under 1%. Joining us now to talk more about these numbers and other big names in the defense sector, Sheila Kahyaoglu. She is aerospace and defense analyst at Jefferies. How's UTX, Sheila, just for starts? Because you've had time to look at that. Yeah.
They raised guidance by about 1% at the midpoint. They raised organic growth from 3 to 5 to 4 to 5%. They had about a 15-cent beat. It came from segment earnings, mainly at Collins. That's their recent acquisition that they closed in November.
Rockwell Collins, right. So that stock's up 2.5%. Did you have a feeling for Lockheed Martin? I mean, did that sound about where you thought it would be?
We have a hold on Lockheed, but we are generally positive on defense at the moment. They're trading at a 20% discount to their 3-year history. They're at about a 10% discount relative to the market. We like defense. You're seeing a budget agreement come closer, even though it's only 3% growth at the top line, the $740 billion defense budget figure we're seeing for fiscal 20. I think it provides visibility where you're seeing a lot of volatility from industrials.
So 3%, it's capped at 3%, or that's where we come. Some people seemed happy with that. It doesn't sound like a huge number, but I mean, there have been years where it didn't go up, right?
We're pleased with it at the moment. So it's for fiscal 20. There's about an 18-month lag from defense outlays to defense contractor revenue. So it provides visibility through fiscal 21, essentially. And we would see a fiscal 21 number out there as well that's calling for slight growth.
Boeing is out tomorrow with its results, and obviously we heard a lot when they announced their write-down. Yesterday, Boeing's outlook got downgraded by Fitch as well as Moody's. What's your take on what that could mean for Boeing, even if it's a higher cost of capital as it goes out to the debt market once again?
I think they de-risked earnings significantly by putting out a charge. The market likes uncertainty removed from it. We'll see the charge of $4.9 billion in the form of concessions, service agreements, whatever it might be with the airlines, but at least it puts a snapshot on what it looks like. And what we did is we lowered our gross profit margin for that program, the 737, from about 32% to 30%.
Do you see the debt ratcheting up as much as Fitch is forecasting? I think that they said that Boeing currently has debt of about $14 billion or so, and they see that going up by about 10 in the next year or so.
It depends on how the supplier payments will work and how advances will work. So we'll look to the free cash flow number tomorrow to see what it looked like in Q2.
Do you feel that the defense industry is all the way back, part of the way back, still more work to be done? Do we need a different type of defense industry for future conflicts? I mean, it's hard to justify spending all that money if we're never going to use any of these things, right? But it's almost like a deterrent, and you have to do that. I mean, how do you feel about guns and butter and all the arguments that we
Sure. So maybe all defense is not created equal, and what we're viewing is we're more negative on the procurement budgets, more positive on the R&D budget. So our hold-rated stocks are Lockheed and General Dynamics, mainly because they're procurement focused. And our top pick is LHX. That's the new L3 Harris combination because we think it'll benefit from R&D spending. Northrop, it's in the areas of space and cybersecurity. So that's how we're positioning within defense.
Just remember reading some anecdotal evidence about the two wars we're still fighting, actually. And there can be people in the defense industry that want to plan for these future wars and neglect the wars that were the low-tech wars we're in right now. For example, the vehicles. There was a way to fix those, the vehicles that we were using where all our guys were getting maimed and killed. And the money wasn't there for that, but it was there for these futuristic weapon systems. So, I mean, we need to do this right. Are we doing it right?
I think we've caught up a lot on... And we're still seeing that short cycle demand come through. Honeywell reporting 20% increase in their defense business, that they're very short cycle. They supply systems to land vehicles, missiles, whatever it might be. So we're still seeing that spending come through. Our positioning is just more positive on that future spending. And that's why I think this UTX Raytheon merger, we need to see more of that technology perspective to see the rationale behind the deal.
one of our contributors, Sorkin, Barney Frank, he wants to go to like zero, basically, on defense spending, because it just...
Not zero.
But much lower, half,
Lower.
at least.
He would like to lower.
Right. I'm just, it just depends on who's in the White House a lot on how we do this.
It does, but this latest agreement last night creates visibility for fiscal 21 as well. And if you think about that lag, that's heading into 2023 for the revenue for the contractors.
Right. Well, we have the greatest in the world, you would say right now, the defense industry.
I think you're seeing pickup in spending from other countries as well, and that's partially what's driving our defense spending increases.
All right, Sheila.
Thank you.